Hello learners, hi, how are you all? I hope your examination preparations for CA intermediate is going really well. And I am back again with one more video to help you all in your examination preparations. So in the last video we discussed bonus issue, and in this video we'll be discussing about right issue. If there is any other topic that is bothering you in your exam preparations and you think I can help you with it, please do mention the name of the topic or the subtopic in the comments to this video so that I can come back with video on that topic. So without wasting much time, come let's get started with right issue. Right issue is option given to the existing shareholder and not an obligation. So as a shareholder, I have been given a right, I have been given an option by the company to either buy the shares of the company or choose not to buy the shares of the company. So it is an option given, exclusive voucher given to me. I would have to give the voucher and also give the money, and only then the shares will be allotted to me. It is not a free share like bonus share. So not everyone can buy. Only the existing shareholders can buy. You cannot buy any number of shares. You can only buy the number of rights that is allotted to you. For in case, if I hold two shares, company will say one right for every two shares, meaning I can buy one share using that right. If I want to buy two, I can't. I have an option either to buy one share by giving that right and also giving the money that is being told, or sell that right to somebody else so that they can buy the share on my behalf, or do nothing. Don't buy it, don't give to somebody, keep that paper with me and then throw it in the dustbin later. Because of which बाद में पछताओगे. You'll understand it little later. So let's get into the topic of right issue. As I mentioned, the shareholder has an option either to buy or to renounce. Renounce means sell it to somebody or do nothing. Now, let's take an example of a company. Let's say the name of the company is Dolakpur Limited, in which the shareholding pattern is this way. There are 20,000 shares, of which 10,000 shares is held by Bhim. That is 50% holding. Now, let's say 5,000 shares or 7,500 shares are held by Chutki, which comes to 37.5%. And the balance of 2,500 shares, guess who will hold it? Raju. Raju holds the balance 2,500 shares, which comes to 12.5%. So this is the holding of the company. Now the company Dolakpur Limited is expanding. They are not happy with the capital of 20,000 shares. They want to raise further capital, for which they are issuing 10,000 shares. Now when they're issuing 10,000 shares, if the company doesn't go with right issue, company does not do right issue, what will happen? And the entire shares are bought by some outsider. Because the company doesn't do right issue, there is no right given to Bhim, Chutki and Raju to buy the shares. Shares are bought by somebody else. Shares is issued to someone from another village or someone from the same village who's not good. Maybe like Kalia. In that case, what happens is Kalia buys 10,000 shares which are issued by Dolakpur Limited. Now, the entire shareholding of the company is no more 20,000 shares. It is 30,000 shares because it was 20,000. Now plus 10,000 shares are issued. Being now holds 10,000 shares, but it is not 50%. Previously, he held 10,000 out of 20,000, so it was 50%. Now he holds 10,000 out of 30,000 shares, so his shareholding percentage has dropped to 33.33%. And Chutki, who held 7,500 shares, had 37.5% stake in the company. But that 7,500 is no longer out of 20,000. That 7,500 is out of 30,000 shares now, which has reduced their percentage of holding from 33.33, from 37.5 to 25%. And Raju, who held 25% shares, had 12.5% stake in the company. But now Raju will have only 8.33% stake because it is 2,500 shares out of 30,000. All of this change in the percentage of holding between Bhim, Chutki and Raju is happening because now entered a new shareholder called Kalia, who holds 10,000 shares, giving him 33.33% voting rights in the company. Because of this, what has happened is the existing shareholders percentage of shareholding pattern has changed. The majority was held by Bhim, 50%. He is no more the majority after this issue. So the impacts of this issue is the shareholding pattern has diluted, The shareholding of the existing shareholders has diluted and the shareholding percentage pattern has changed. And another important observation is the majority percentage which was held by one shareholder before is no longer the majority. Now, how do we fight against this? That's where the concept of right issue comes. To ensure that the existing shareholders have the right to retain their percentage of holding in the company, company will give them rights. Company will give them an option to acquire the shares in the same proportion in which they had the shares previously. To ensure that even after this issue, the percentage of holding that they have in the company is still the same. The company has 20,000 shares, which was held between Bhim, Chutki, and Raju. The company is issuing 10,000 shares. If the company goes for right issue, then the issue pattern should be somewhat like this. The 10,000 shares are to be issued to 20,000 shareholders. Meaning 10,000 for 20,000 is one right for every two shares held. One share should be given as a right share to every two shareholders. Beam, Chutki, Raju are holding 10,000, 7,500 and 2,500 shares. So the additional 10,000 shares should be given as 1:2 ratio. Beam will get 5,000 rights, that is 10,000 into 1 by 2. Chutki will get 3,750 rights, that is 7,500 divided by 2. Raju will get 1,250 rights, that is 2,500 divided by 2. Let's see it. So the existing share pattern is 10,000, 7,500 and 2,500. They will get plus right shares. Beam to get plus 5,000 right shares. Chutki will get 3,750 right shares. And Raju will get 1,250 right shares, which will make their total shareholding 15, 11,250 and 3,750. And now the total share capital of the company is 30,000 shares. So 15,000 out of 30,000 is still 50%. 11,250 out of 30,000 is still 37.5 and 3,750 divided by 30,000 is still 12.5. So by right issue, it is possible for the existing shareholders to hold the same percentage in the company. And again, there is no obligation with Beam, Chutki and Raju to buy these shares. It is just the option with these shareholders to acquire this share to ensure that their percentage of holding is same. And it is not obligation. Are you guys getting it? It is only right with them. Meaning, an existing shareholder has an option either to acquire, sell it to somebody, or do nothing. What are the impacts or effects of this right issue? By this right issue, the company will maintain same proportion among the existing shareholders. The value per share will decrease. The reason being that when the company gives that right shares to Beam, Chutki and Raju, the price at which those right shares are given. I told you it is not free share given to Beam. Beam has an option to buy. So he has to give money to company and then buy. The rate at which Beam will buy that share will be definitely lesser than the market price. If in case in the market on that date before right issue, the share is 125, when the right shares are issued, when the rights are given to Beam, to buy the right share from the company, he doesn't have to pay 125. He has to pay some amount which is slightly lesser than 125. Because the right price is slightly lesser than the current market price, after right issue, the share price of the company in the market is going to decrease. So this is a normal phenomena which can be observed. And convenience of issue is definitely there. You don't have to go to an external shareholder, convince him to buy by way of stating some amazing facts in the prospectus. An existing shareholder is more easily convinced to buy the shares. So there is definitely convenience of issue. And image of the company will become better because company is caring about its existing shareholders. And talking about conditions for right issue. What are the conditions based on which the company can go for right issue? The notice has to be given mentioning how many shares is the company going to issue by way of notice. And the time period for this notice is 15 to 30 days. And then the point is that notice whatever you give, the offer that you give to existing shareholders should give an option to them to either buy the shares or renounce these shares to somebody else. Meaning, I am Beam. I have been allotted 5,000 rights. Either I can pay 120 rupees against each of those 5,000 rights and then buy the shares, or I can sell it to you. Not the share. I am selling the right to you. Using that right, you can pay the money and you can acquire the share from the company. Such an option should be given. Unless The articles of the company puts a restriction. What if our company is a private company? Private company restricts public people to participate, no? So now it's a private company between me, Chutki and Raju. When rights are given, I should buy. I can't give it to Kalia who's an external person. Are you getting it? So option to renounce right should be given. The condition is that unless it is what to say authorized or articles of association provides for it otherwise. If article says no, rights cannot be renounced, then rights cannot be. Got this? Then the point is, can a company issue shares to an outsider without doing right issue? As a company, is it obligation on me to issue right shares, or can I skip the existing shareholders and give it to third party? If in a regular class I give time for people to think about this, come back with the answer the next day. But because it is a recorded video, you guys don't have such what do you say condition. You can answer it. I would recommend you to pause the video, think about the answer, freeze your mind, and then continue the video so that you will be able to check whether you knew the correct answer. There you go. Let me tell the answer. Company can make share issue to outsiders without right issue if such shares which are issued are by way of employee stock option plans, or these are converted. Previously we had issued convertible debentures, and against those debentures we are issuing shares either for government or any other loan or debentures that we have previously issued. And in this, or there is also a possibility where I am going to skip my existing shareholders, issue the shares to outsiders, provided the rate at which I am issuing the shares to outsiders is determined by a registered valuer, so that I am not doing any mismanagement and oppression. Just to ensure that if the price is determined by registered valuer, I can skip the existing shareholders and issue the shares to an outsider. So this is with regard to theoretical and legal aspect. Now let's get back and then see the options with the shareholder. As a shareholder, I have three options. I can either hold the share, I can sell the right to somebody, I can buy the share, I can sell the right to somebody, or I can do nothing. So there are three important factors based on which the questions will come in the exam. First one is come right value per share. Come right value per share is the market price per share before right issue. So let's say the right issue is happening tomorrow, wherein I buy the right shares of the company. The value of the share today is called come right issue, meaning that chicken has egg inside. Once that chicken is sold, it will lay the egg tomorrow. Like you do X interest, come interest in investment chapter, like you do their cumulative interest, cumulative dividend value or cumulative interest price, this is the same thing. So come right value is the value of the share against which rights are due, not yet issued by the company. And like I mentioned, price per share uh, after announcing the right issue but before issue of rights. The right issue is not yet made, but the company has announced. So each share has a right involved in it. So that's what we call as cumulative. Then comes X right price. X right price is value of the share after the right issue. Always and always, X right value will be lesser than the cumulative right value. For example, in the market, if each share's value is 150, after the right issue, value will be lesser than 150, like 140 or 130 or 120. This is because, let us say, there are 4 shares that I hold of rupees 150 each. In the market, value is 150. When the company gives me rights, let's say company will give one right for every 4 shares. I have a right to buy one share. That one share I would have to buy from the company. When I have to buy that share from the company, I'll give that right that they have given to me, and I'll give money. How much money to give? That is called as right issue price. The price that should be given along with the right by the existing shareholder to buy the share is what we call as right issue price. This right issue price will be lesser than the cumulative market value. In the market, the shares are being sold at 150 for an external person. Me being the shareholder, I will get the share of the company at a price lesser than 150. So now we have certain shares which are sold by the company for a price less than 150. So number of shares in the market will increase, because of which the price will definitely drop. It will get equated. I'll tell you how. X right value of the share is value of the share after the right issue. Price per share after right issue. In our example, let's say I had 4 shares at rupees 150 and the company is issuing me 1 share at rupees 120. Company is issuing me 1 share at rupees 120. That is right share. And the X right value is 4 shares into 150 rupees plus 1 share into 120 rupees divided by 5. Now I have 5 shares after the right issue, of which 4 shares I bought for 150, 1 share I bought for 120. So that's how we find X right value, or we also call it as theoretical X right value, which is come right value per share multiplied by existing shares plus right issue price into right shares divided by existing shares plus right shares. I hope you all got this. Then we'll take the point called as value of right. Value of right is the difference between the X right value and the come right value. Cumulative right value is before right issue, X right value is after right issue. So the difference is right. Meaning, if in case I sell the rights, now I have 4 shares with me. Company has given me 1 right. I told you I have an option either to buy that share or to sell that right to somebody. Now when I'm selling that right to somebody, what money should I collect? That is the difference between the come right value and X right value. Are you getting it? Because if I don't sell it, the share price in the market is going to dip and I'm going to face a loss. I will show this to you with the help of an example. For now, all you need to notice value of the right is the value which I'll receive for selling the right. Now, when I sell the right to somebody else, I'm not selling the share. I'm only selling the right to buy the share. So if I sell it to person A, he gives me money for buying the right. Using that right, he buys the share of the company, should pay money to company also. Got it? So value of right is cumulative right value minus X right value. So this is the sale price of each right if sold, or this is the decrease in the value per share. Like I mentioned, come right value minus X right value. Let us understand this with the help of an example. Like I told, options with the existing shareholders are 3. Number 1, subscribe to right shares. Number 2, sell the rights. Number 3, do nothing. Let us take an example where same thing, 20,000 shares are there. Beam holds 10,000 shares, which is 50%. Chutki holds 7,500, that is 37.5%. And Raju holds 2,500 shares, which is 12.5%. Let us take a case where right issues of 10,000, same to same. I am going to give you a little more data. That is, what do you say? Nominal value is 100 per share, cumulative right value is 150, and right issue price is 120. If Beam exercises the option, then what will be the X right price? It would be somewhat like this. Beam is entitled for 5,000 rights. Beam buys the share. Let's say option 1, Beam subscribes to shares. Beam had 10,000 shares at rupees 150 plus now he has bought 5,000 right shares at rupees 125. Total divided by he has 10,000 plus 5,000, 15,000 shares. If I find it, it is 150 plus 6,25,000 divided by 15,000, which comes to 141.67. So before the right issue, the value per share in the market was 150. After the right issue, it becomes 141.67. First part, you wouldn't understand this completely till now, till the time I finish the third option. Wait till then you would understand this better. Let us say Beam sold his rights. Beam doesn't want to buy shares. Beam sold these rights to somebody. Now, when Beam sells these rights, how much money should he receive? Value of right, which is the difference between cumulative right value and the X right value. That is, before the right issue, the price is 150. After the right issue, the price is 141.67. We've just found it. See here, 141.67. So if you find the difference between these two, I'll find the value of right is 8.33. And he has right against 10,000 shares, not 5,000. 5,000 rights, but he has rights against 10,000 shares. So I'll do number of shares with Beam is 10,000. Value of right for each share is 8.33. I'll do 10,000 into 8.33. 83,300 rupees is the price at which Beam can sell these rights. Is not selling shares, is selling rights. And the cost price of these is 0. Cost price is 0, selling price is 83,300. Entire 83,300 is profit. We would have done this in accounting standard 13 investment accounting, that sale consideration received for sale of rights will be completely transferred to P&L account credit side. Entire consideration. There is no cost against it. I hope you got this point. Going a little further, what if Beam does nothing? Beam doesn't buy shares, Beam doesn't sell the rights to somebody, then Beam's shares of rupees 10,000 will remain the same even after right issue. But before right issue, per share price was 150. After right issue, per share price become 141.67. Meaning he had 10,000 shares at rupees 150. Now he has 10,000 shares at rupees 141.67. Because he neither bought the shares nor sold the rights, the price per share is reduced with regard to B to 8.33 per share. So it was 15 lakh rupees before right issue. After right issue, it has become 14 lakh 16,700. So the loss that has happened to Beam for him doing nothing is 83,300. This is the money that you would have got if you would have sold the rights. So in a wise market, if there is right issue, you should either buy those right shares or sell those rights to someone. If in case you want to see the practical side of it, in your demat account there will be some things that would come called rights. You have an option to sell it like you sell shares, and the entire part is profit. And if in case you don't sell it, you are going to face the consequence of decrease in the value of your shares. So this is it with regard to right issue. All you need to remember is these two important formulas for computation of answers to the questions that will come in the right issue topic. Number one, X right value, which is cumulative right price multiplied by existing shares plus right shares into right price divided by existing shares plus right shares. And the value of the right is cumulative right price minus X right per share. If in case the question comes on right issue, it will be for 4 marks. A separate question is very less expected. However, questions can come on this topic in the chapter of investment accounting. So I hope you understood this video. If in case this made you understand the concept of right issue in detail, please do drop a like and then mention it in the comments as to how was this video beneficial. And also don't forget to subscribe to this YouTube channel and also mention in the comments what topic do you want me to cover in the upcoming videos. I hope you learned something new and also had fun in this video. Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you're learning something, you're having fun. It's all good. The day you guys either stop learning something or stop having fun, trust me, you might start struggling because you might be in a battle. So the thumb rule to stay happy is pretty simple. It is to stay in the game. So for one last time on this day, I have just one simple question for all of you. Are we in the game? I hope the answer is yes, we are in the game. See you all in the next one. Till then, tata, bye bye, take care, and get lost.